Yeah, possibly. I mean, I think first of all, we needed a correction, and whether it's because the case, the daily cases in Europe are now ahead of the U.S., or the debates next weekend, or the election coming up, we needed this sell-off. But this is a great thing, and I think that investors have to remember they have to be comfortable being uncomfortable. And so I think it was a very healthy sell-off. Would like to actually see a little bit more, because that's going to be a good opportunity to get back into some of these growth names that are having a tiny little correction right now.
Yeah. Steve, how do you assess what's going on in the market now and the way that investors need to, not only think about it, but put it in perspective? You have, the virus situation over in Europe, the UK and Spain. 200,000 and counting deaths now in the United States, and cases ticking up in a number of places. You have the fallout politically, obviously, from the death of Justice Ginsburg. You have the possibility of chaos looming on election night. That's not that far away. So how are we supposed to, as investors, put all of that into perspective in the way we're thinking today about this market?
Well, the first thing is I stopped trying to read the tea leaves, like Apple's positive, so that's great for the market. None of this matters. Here's what does matter. When the Fed comes out and when they hold rates steady or take rates lower, the market almost always has a positive response to it. We didn't see that. As a matter of fact, we saw a negative response from the get-go. What that means is not that investors have lost confidence in the Fed, but they believe that the Fed's out of tools, and they don't believe that the Fed's going to be able to drive inflation over 2%.
You think
but
that?
Even if they do,
you think that?
their
Maybe,
target's 3 years away.
I don't know. I mean, I think people still have confidence in the Fed. I really do, or the market wouldn't even be anywhere close to where it is now. Maybe, Steve, it's just a realization that it was a somber and fairly sober look at where we are currently in the economy. Regardless of what the Fed can or cannot do, the economy is what it is right now, and it's not great.
Right. Exactly. And I said the market hasn't lost confidence in the Fed. They just don't believe there's more in the toolbox, and there's a lot they can do to get the economy going. So it comes down to the economy. It comes down to the election. That's what's going to keep sort of a governor on the market until we get through the election. They don't know that there's a president. We know for a fact we won't have a president right now on Election Day. So how long will that go? You go back to when Bush got elected. So to me, I just see a much worsening trade situation. I see CEOs, at least the ones I talk to, of large companies, further retrenching. They have no idea where they should put money, whether they should invest in CapEx. And you're seeing the opening again trade just dissipating. So I'm with Bryn, I'm with Joe. Part of it's technical, a lot of it I think is fundamental and macro. But it's too early to put money to the market. The market really hasn't corrected. Valuation just hasn't taken a big enough hit for me to get comfortable. And when you want to invest, you want to be uncomfortable when you're putting money to work, but you also want to be an easy decision in terms of finding values that you can really hold on to. You're not there yet for either.
So we're at, down nearly 10% from the S&P's most recent high of September 2nd. Nasdaq, as you know, is down 12.5%. So it's been hit much harder. So, Jim, playing off what Steve Weiss said, are we truly in no man's land until we get through November 3rd?
I don't think you have to wait that long. Maybe you do, but I just don't think so. Look, I think a little perspective here helps. Everything that was just said about this being a technical correction, I agree with. And all we've done is go back to July 29th on the S&P 500. So we've taken out the August rally. We've just vanished that, which frankly is appropriate. That was frothy. It was bubblicious. It was based on a lot of call buying, whether it's by SoftBank or Robinhood. It was based on supposition that Tesla was going to get added to the S&P 500. It was not fundamental, and it had to come out. And now we're at a level where, sure, we may go down. I mean, there's another 4% on the S&P 500 until you reach the 200-day moving average. That's the key support that you'll look to. Now, you may reach that moving average, but that's only 4 percentage points away. And from there, you can start growing again. I'm not as negative as what I heard some people saying a minute ago about the economy. Look, yeah, the economy's in rough shape, but the statistics are coming in better than expected, and particularly where it matters, which is the labor reports. Weekly jobless claims continue to surprise to the upside, and the employment sub-indices of the Fed surveys look pretty good. So, yeah, there's risks, but things are coming in better than expected right now.